to this guy, Pulitzer Prize winner, the co-founder of DCReport.org, such great investigative work. He's a best-selling author, and I recommend David Cay Johnston books. And I think you can needle drop them. You know, you can almost crack these books open anywhere, and you can see how the system is set up to favor the rich and well-connected. It's not, you may say, yeah, I know that, but wow, when you see the ways in which it happens, it's extraordinary. And if you want to see the receipts shown on Donald Trump's life, David Cay Johnston's books. I'm betting he'll want to talk about SVB and the FDIC intervention. Let's get him on now. Yeah, David Cay Johnston, everybody. Hi, David.
Hello, Mark.
So, David, what's your take on this? A major Silicon Valley bank goes into receivership, essentially, or the FDIC. What's your take on the way it went down, and also the bailout, or is it a bailout?
It's not a bailout in the normal sense that the restoration of funds will come from the Federal Deposit Insurance Corporation. All banks pay into the FDIC. There's a similar setup for savings and loans and for credit unions, a premium, and the more risky your bank is, the higher your premium. But this will heavily drain the assets of the FDIC, which are only about $250 billion. Think about the size of banking in America. That's not a very big number. I have a piece that will be up at DC Report shortly about what I think is the most important thing of a number of things which are not being discussed in the financial press and not being discussed by policymakers in Washington from Joe Biden on down. SVB, Silicon Valley Bank, made lots of loans against Bitcoin and other cryptocurrencies. They were the banker for one of the big cryptocurrency outfits. And in my mind, cryptocurrency is a collateral equivalent to ice cubes in January, which we know will melt come spring and evaporate come summer. There's nothing there. And I go into why that's the case in my argument about it, because I'm sure there are some people listening going, no, crypto is the future. No, it's not. It is a scheme. It's a Ponzi scheme that just doesn't have a single person like Charles Ponzi or Bernie Madoff behind it. It has no legitimate use, and in fact is primarily used for things like laundering money from drug trafficking and prostitution, hiding assets from the government, business partners, and estranged spouses. And one of the ways you know it's not a currency is that by design, it can only handle, the Bitcoin system can only handle 7 transactions per second. Now think about how many people in America whip out their Visa, MasterCard, American Express, and buy something every second. It's just astonishing to me that the banking regulators are allowing cryptocurrency to be security for loans, which is one of the factors in the collapse of Silicon Valley Bank. SVB, according to its website, would loan you 50% of the value of your currency. There are banks that will loan you 90%, and there are even banks that will give you zero interest loans. And I have links to the pages to show you this when the story goes up at DC Report. That's just one of a number of problems that are simply not being addressed in Washington. Another one, Mark, I fear will be swept under the rug is there are pretty clear indications that this bank was involved in a very deep back-scratching relationship with the venture capital crowd, making loans which allowed people to live tax-free by borrowing against assets that they owned but had never realized for tax purposes. I can't prove that to you, but all the signs point to that, and we know that this goes on in the country. I've written about that since, the mid-90s. And in addition, they appear to have made a number of absolutely improper loans, that is, loans to people who they may own speculative assets in a startup, but don't have the income to back buying a house or a fancy sports car or something like that. And, we've been regulating banks for 7,000 years. I just last week or the week before had taught my pre-law students about proto-banking leading to and proto-banking regulations leading to the modern ones. We did get banking regulation right from 1935 until about 1980. Almost no banks failed. But since then, this attitude that, well, bankers got rich handling money, that we should just leave them to their own devices. And Donald Trump's stepping in to allow Silicon Valley Bank, my bank, M&T, or my family banks, to escape a regulatory review, particularly something known as a stress test. What would happen to your bank if interest rates suddenly went up 3% percentage points, 5 percentage points, which is exactly what we've just seen happen. And finally, of course, and this has been in the news, this bank went 9 months, almost 9 months, with no risk officer. Having a risk officer is fundamental to banking. And when interest rates are being raised by the Fed, 8 raises in less than a year now, from essentially 0 to 5%, you absolutely have to have a risk officer. Well, this bank was heavily invested in federal treasury notes and bills and bonds that paid very low interest and whose value sank as interest rates rose. How did this happen? The CEO was on the board of the San Francisco Federal Reserve Bank. So
the Justice Department kind of agrees with you, it seems, or at least apparently there's a federal investigation now into the Silicon Valley Bank collapse. And the idea somehow that there was a little bit of a tech bro network or a VC network to which you've referred, that seems to have maybe informed a lot of what happened. Wasn't the run really triggered by, one tech bro telling another tech bro? I call them tech bros. These are, Peter Thiel types. They're billionaire guys. Right.
So Peter Thiel, who was deeply involved with this bank, somehow got wind that there was trouble and withdrew money that wasn't, with knowledge not available to the public. It's hard to believe that the CEO of this bank, the guy who just resigned from the Federal Reserve in San Francisco, didn't know months ago that disaster was on its way, even without a credit risk officer. If he didn't, he has no business running a bank. The CFO of this bank was the chief administrative officer. I think CFO is the title. One of the very top executives at the bank was the chief administrative officer at Lehman Brothers, which collapsed in 2007 and touched off the Great Recession. What are these people doing in positions like this? Where were the regulators on other issues? And so, we got banking regulation right in 1935 under FDR. We had rules about prudence and behavior. So after all the banking failures that occurred, particularly in 1932, that wiped people out, that ruined businesses, that were central factors in the Great Depression, we got a series of banking acts, the Glass-Steagall Act, that said you can be in the underwriting business for new securities, you can be in the insurance business of any kind, you can be in the banking business, but you can't mix those. We undid that. We removed all sorts of rules that, business people complain were excessive. And, having run businesses, I understand that, it's oppressive and difficult and all of that. And that, for Citibank or Chase with over $3 trillion in assets to deal with compliance, they just hire people. For a smaller bank, that's a problem. This is a bank that had over $200 billion of assets. We're not talking about a mom and pop bank, and there are lots of them still around the country. Not enough of them, but a lot of them.
I'm glad you said that, because I think this is, characterizing this somehow as a, smaller community bank is a little bit of a mischaracterization.
It's just absolutely outrageous. This was the 16th largest bank in the country, the second largest bank failure in American history. Washington Mutual was the biggest back in 2008. So no, this is not your little, community bank. We have a little bank here in Western New York, the Bank of Castile, and I think it's got 1 branch or maybe 3, but it's a tiny operation. This is a big operation. There's another factor, Mark. This has gotten some news, but not enough. Apparently 50% of the money venture capitalists put out into startups were held at this one bank. That is a concentration of risk that is absolutely crazy. It's not as crazy as using Bitcoin as collateral for a loan, but it's pretty close. And it tells you that we figured out once how to get banking regulation right, and we threw it away. We would be so much better off if we'd go back to the rules of prudence. And that's what you want your banker to be. That's why, banks used to be these buildings, right, with big, tall columns clad in marble and looking very stately and imposing. So you would have a sense that they were substantial. Drive around now. There's all sorts of banks that, if the bank moves out, the owner of the land they're leasing may just knock it over and put up another building. And some of these banks are just that insubstantial.
It's interesting because the bank was also doing, I saw something in the chat there about acquiring China. Yeah. But in addition to that, just in this country, SVB was acquiring other banks. I mean, it was there was quite an aggressive move to increase the footprint, if you want to think of it that way, of SVB.
Well, one of the problems with capitalism, which has done a lot of great things for the world, made a lot of people a lot richer because it's a way to marshal assets, manage them efficiently, and grow businesses. One of the problems is the tendency for the more successful firms, or the ones that appear more successful, to buy up the less successful ones until you get to a monopoly. And in banking, the too big to fail banks from 15 years ago, they're now far bigger than they were back then. That we didn't do the regulations right. We had 31, I think it's 31 or 36 class 1 railroads, big railroads in this country in 1980. Now we have 7, although I would argue it's more like 5.5 because of the interconnections between them. Monopoly is not capitalism. Oligopoly, a handful of firms controlling the market, is not capitalism. And we've never figured out very well how to stimulate competition and make sure that there are lots of different places so that if a bank fails, then it's not a systematic threat to the whole economy. That's the reason, by the way, that the Federal Deposit Insurance Corporation is going to make sure everybody's made whole because of the contagion fear that, what about my bank? And people start pulling money out of banks. If you got $250,000, you're totally safe. If you're above $250,000, here's my advice to you. When my son and I had, mostly my son, had a hotel management company, we'd get about $800,000 in advance deposits for the summer season. And the limit then was $100,000. Well, guess what? We had accounts at 9 banks. Put $100,000. As soon as we hit $100,000 in a bank, we would do another one. Because if one bank failed, we'd wipe out our profits for the year. But if 2 banks failed, that was the end of our business. And so $250,000 for businesses is not a high enough protection level. It needs to be, we need to create a class of accounts that are business accounts and maybe raise it as high as $10 million.
They're essentially doing that, David, don't you think? This is, with this assessment, that kind of might be, that isn't this you said it first when we first began this conversation. You said, that's not a very big fund they're drawing from to make this whole.
Well, but what the government's doing this time, for reasons that I think make sense and I support, much as it's not technically a bailout, it's an insurance company using its emergency powers under the law, an insurance company controlled by the government, the Federal Deposit Insurance Corporation. We really should raise the threshold from $250,000. Congress is always, especially the Republicans, are always saying, we have to adjust the tax rate to make sure inflation isn't unfair. Well, there are lots of other rates that we need to just regularly adjust for inflation and the size of business. And so I would think $10 million for business accounts is not unreasonable. And you take the risk above that. And 10 million is enough that you can say, we're going to keep 10 million in this bank and spread the money among other banks, which would, of course, encourage competition. I also, by the way, have a very simple rule, if we could get it adopted. This is not going to happen. That would make sure we don't have mismanagement and failures like this. We could have a rule that says in order to get deposit insurance, if the named executive officers, that's the CEO, the COO, and 3 other people, if the bank goes into receivership, they must give back every penny they were paid for the previous 5 years, except $250,000 a year for them to live on. So if you got $25 million, sorry, pal, for the last 5 years, you're getting $1.25 million, and the rest of it's being clawed back. And if we did something like that, put in a huge clawback that really hurts, guess what? It would encourage prudence rather than recklessness.
Well, you'd see that across so many companies and executives who are never held to account for any number of things. Environmental damage, top of the list in my judgment, but it's just remarkable. Go ahead, Kim. Sorry.
I wanted to add this in because I just saw the story pop up while you guys were talking. And it's Senator Elizabeth Warren's comments today. And she is calling for the Federal Reserve Chairman to stay away from any review of this collapsed Silicon Valley bank fiasco. She says that because Jerome Powell is responsible for policies which played a role in the bank's collapse, he has to recuse himself in order for the Fed's review to be credible. So I just wondered if you had any comments on that.
Powell's going to do what Powell's going to do, but Powell is a guy who believes in less regulation of banks. And there are two institutions in America in finance that need regulation. They're companies that sell insurance products because almost nobody understands them, and banks or lending institutions, so savings and loans, credit unions, etc. But what we really need is an investigation of these broader issues. I'm afraid they're going to sweep under the rug the systemic real issues that led to this problem. If I can change subjects on you, by the way.
But David, I want to change subjects, but I just want to mention one other thing on the Justice Department investigation because it pertains to a little bit of what you just touched on, was the executives. It's suggested that the sale of company shares by several bank executives in the weeks before the bank's failure, that is one thing that'll be looked into, and the way that executives essentially sold stock in something of an insider trading way, but did it in ways to make it not look like insider trading. This is something else they'll be looking at. This is in relation to SVB.
Executives who own stock are allowed to have a pre-planned sales at set dates in the future. This is, it's argued, reduces the risk that they are going to run up the stock price, cash out, and run away. There should be an additional rule that says that, you know, if you have any reason to believe that your bank is suddenly in trouble or your corporation is in trouble, your sale is suspended, or the sale goes through, but the money is held in escrow to protect us. I've argued for a long time that whenever an executive gets stock and then sells it while still working there, they are disaligning their interests with the shareholders. The whole theory of paying in stock is, well, your interests are aligned with the shareholders. Well, no, not if I sold my stock. So I've long argued that executives who exercise stock options should be required to keep those stocks until they retire. The year they retire, they can cash in 20%, and over the next 5 calendar years, they can cash in 20% of the balance. So you've got a 6-year period. That should ensure that the company is left in good hands when you leave.
So reasonable, it will never happen.
Right.
For all the other reasons that you detail in your various books, the ruling class won't let it happen. Now, change subjects. Go ahead.
Well, the pictures you've shown of what's happened with the Pajaro River, which runs next to Watsonville and separates Monterey County from Santa Cruz County, where I grew up. The LA Times has this terrific reporter, Susan Rust, investigative reporter, does great work. And she has had 2 stories this week. The first one, she got the Army Corps of Engineers to acknowledge that they never repaired and fixed this levee, where, you know, time wears levees down, rodents get in there and they create holes that allow water to move, that they've known for years that levee needed to be rebuilt and reinforced. And the guy from the Army Corps of Engineers says very candidly, well, it never penciled out. What do you mean it didn't pencil out? Well, the people who live there are so poor and their houses are worth so little money, it wasn't worth it to fix it. I'm sorry, that's an absolute admission of government for the rich, by the rich, and against the poor. It's despicable. I praise the man for being candid, but that's atrocious. Russ has another piece today in which she points out and quotes a number of people who know these things, that California alone has 13,000 miles of levees. Anybody who's gone over by Stockton and Discovery Bay and all of those areas knows it's all levees. that were put in so that the rice farmers wouldn't get wiped out and whatnot. And those levees are in the same shape, and we're not maintaining them. We've all seen pictures of Mississippi River floods where almost always the enormous damage is on one side of the river. Turns out to be the side of the river where poor people tend to live, certainly not where better off people live. And infrastructure costs money. By not maintaining our infrastructure, we're not saving a dime.
Sure, it's not penciling out the other way. Exactly.
Right. Yeah. Back in 1987, I wrote a column in the LA Times where I was a reporter, but occasionally wrote columns. And it was about the California pothole tax. What's the California pothole tax? Well, when I was growing up in California, I never saw a pothole. I literally never saw a pothole in my life till I was 24 years old. So that's 50 years ago right now, and went to Chicago on a fellowship for 2 semesters. And once Prop 13 passed, we stopped repairing roads. Los Angeles City went from a 40-year cycle to rebuild roads to a 200-year cycle. And I suddenly realized at least once a year for each of my cars, I was going to a front-end alignment shop. Oh. And I looked in the phone books from, like early 1970, because we had collections of them at the paper. And then the yellow pages like in 1987, and the number of front-end alignment shops had grown tremendously. So we weren't saving any money.
That. It birthed an industry anyway.
Yeah, we were just shifting from tax dollars to paying front-end alignment shops. And of course now with the way cars are built, you have to align 4 wheels, and it's more expensive than it ever was. And we have to get away from this notion that once we have built a road or a levee or something, we don't have to do any more work. No, you should build it right in the first place, like the Swedes do. I spent with my wife one time 3 days in Stockholm. We were trying to find potholes, and people thought we were hilarious.
Only David Cay Johnston would do
and
that.
We finally got told by somebody who said, "You want to see potholes? Go to the Iraqi war refugee camp in Oslo." And sure enough, when we went over to Oslo, we looked, and right away there were just terrible potholes on the roads in that thing. But if we don't maintain this, not only are we not maintaining commerce and efficiency, but in the case of Pajaro, which is this poor, basically farm worker, not migrant, but farm worker, permanent farm worker community right next to Watsonville, an agricultural town, we're also discriminating against poor people. And we should all be offended by that.
Well, and I think, as you've suggested, deferred maintenance of the sort that you've alluded to is it just ends up costing you more in the end. I was making that point at the beginning of the show, but you make it in economic terms. I was making it in sort of wholesale terms, that it's hard politically to get these infrastructure packages through because it's not an immediate threat. Often we lived in those drought years. It's like, what are you talking about? Redo the.
Yeah, I mean, who wants to pay for buying a new roof? I mean, it's understandable, exactly. But we can rise above that. I call this, and I didn't originate the term. Senator Moynihan did. Malign neglect.
Oh, wow. Yeah.
It's across its path. As opposed to benign neglect.
As opposed to benign neglect, yeah. Find his latest at dcreport.org. He's the co-founder there, and then check out his many books, the best-selling author, Pulitzer Prize winner, and here with us so generously on Tuesdays. Thank you so much. David Cay Johnston.
Take care, Mark.
See you, David. Thanks so much. Hi, it's Mark, and I thought that was great. Hit the notification bell. You'll know whenever there's a new video being dropped, and please subscribe to our channel to help us save the universe.